The average new car payment in America is now $734 a month. That's $8,808 a year, just for the car payment alone. But that number, that's not even close to what that car is actually costing you. Because here's the thing that nobody at the dealership will ever tell you. Someone making the exact same money as you, living in the same city, driving a car that costs half as much, could retire with over $1 million more than you will. And it all comes down to one single $500 decision that you're making every single month, without even thinking about it. My name is Felix, and I create easy-to-understand animated videos about personal finance. If that's something that interests you, consider subscribing. There's a concept I call the $500 fork, and once you understand it, you will never look at a car payment the same way again. The $500 fork is the invisible decision point that happens every single month in your financial life. Every time $500 leaves your bank account, it goes one of two directions. It either flows towards something that loses value the second you buy it, or it flows towards something that grows in value every single day for the rest of your life. One fork leads to a depreciating asset. The other fork leads to a compounding asset, and the difference between those two paths over a normal working lifetime is not $10,000, it's not $50,000. The financial industry understands this math perfectly. Car manufacturers understand it. Banks understand it. But nobody in that transaction has a single incentive to explain it to you, because they all profit from you choosing the wrong fork. By the end of this video, you'll understand exactly why that $500 a month car payment is the single most expensive financial decision most Americans will ever make. And I'm going to show you the precise math, line by line, dollar by dollar, of what that same $500 could become if you just pointed it in the other direction. Let's start with how we got here, because this wasn't always the reality. In 1950, the average new car in America cost about $1,500. The average household income was about $3,300 a year. That means a car cost roughly 5 months of income. You could save up for it, you could pay cash. Car loans existed, but they were short. 2 years, maybe 3. The idea of financing a car for 7 years would have sounded absolutely insane. Fast forward to today. The average new car in America now sells for nearly $50,000. The median household income after taxes is about $72,000. That means a car now costs roughly 8 months of take-home pay. The math flipped completely. But here's where the auto industry pulled off one of the greatest psychological tricks in modern capitalism. Instead of letting you feel the pain of that $50,000 price tag, they trained an entire generation to think in monthly payments. They don't say, "This car costs $50,000. They say, "This car is only $734 a month." That reframe is worth billions to the auto industry. Because the second you start thinking in monthly payments, you stop doing the real math. And according to Edmunds, 21.5% of new car loans in 2025 were 84 months or longer. 7 years of payments. That's not a car loan, that's a mortgage on a machine that loses 20% of its value the moment you drive it off the lot, which honestly sounds like something from a financial horror movie. The average auto loan term is now 69 months. That's almost 6 years. And according to AAA, the total annual cost of owning a car in America, when you include the payment, insurance, gas, maintenance, and depreciation, is $12,182. That's over $1,000 a month to own one single car. Here's a number that should genuinely terrify you. Research from fleet management studies found that the average American will spend approximately $470,000 on cars over their lifetime. $470,000. Let that sit for a second. That's nearly $500,000 flowing toward assets that are mathematically guaranteed to be worth less tomorrow than they are today. That's wealth destruction with cup holders and heated seats. Now let's talk about the $500 fork in action, because this is where the math becomes absolutely devastating. Let's say you invest $500 a month into a simple S&P 500 index fund. Nothing fancy, nothing risky. Just a boring index fund that tracks the 500 biggest companies in America. The S&P 500 has returned an average of roughly 10% per year over the last 30 years, including dividends. That's not a fantasy number. That's historical fact. Here's what $500 a month looks like when you send it down the compounding fork. After 5 years, you'd have about $39,000. You put in $30,000. The market gave you an extra $9,000. After 10 years, you'd have about $102,000. You put in $60,000? Not bad, right? But we're just getting started. After 20 years, you'd have roughly $382,000. You put in $120,000. The market gave you $262,000. Your money now makes more money than you contribute. After 30 years, $1,130,000. You put in $180,000 over those 3 decades. Compound interest gave you $950,000. Your money made 5 times what you put in. And if you kept going for 40 years, from age 22 to 62, $3,159,000. Over $3 million. From $500 a month. But it gets worse. Because now let's look at what actually happens when that same $500 goes down the other fork. Let's meet a couple we'll call the Parkers. They're a pretty typical American household, combined income of $85,000 a year. That puts them slightly above the national median. They should be comfortable, right? Let's watch what actually happens to their money. Their gross income of $85,000 sounds solid, until taxes show up. After federal income tax, state tax, Social Security, and Medicare, they're left with roughly $5,500 a month in take-home pay. Mortgage, $1,500. Now they have $4,000 left. 2 car payments, combined $1,000. That's $500 each. Now they're at $3,000. Car insurance for 2 vehicles, $380 a month, down to $2,620. Gas for 2 cars, $350, down to $2,270. Groceries, $700, $1,570 left. Utilities, phones, internet, $400, down to $1,170. Student loan payments, $350, down to $820. $820. That's what's left of $85,000 a year. And we haven't touched clothing, haircuts, medical copays, kids' activities, car maintenance, home repairs, or the psychological need to occasionally leave the house and pretend you have a life. Now you might be thinking, well, Felix, that's just life. Everybody has bills. And you're right. But here's what I need you to see. Inside those bills, there is $1,730 going to cars every single month. That's the 2 payments, the insurance, and the gas. $1,730. That is 31% of the Parkers' entire take-home pay being swallowed by machines that lose value every day. If someone told you they were spending 31% of their paycheck on coffee, you'd stage an intervention. If someone told you they were dropping $1,700 a month on clothes, you'd assume they had a serious shopping addiction. But somehow, when it's cars, we just nod and say, well, you need reliable transportation. And that brings us to the concept I call the depreciation drain. Because the car payment isn't even the most expensive part. Depreciation is the thing that makes this whole equation absolutely brutal. That $50,000 car the Parkers just bought? After 1 year, it's worth $40,000. It lost $10,000 in value just by being 1 year old. After 3 years, it's worth about $30,000. After 5 years, roughly $20,000. The car lost 60% of its value in 5 years. That is not an investment. That is not an asset. That is a financial black hole with Bluetooth and lane assist. But it gets worse. I'm not done yet. Let's talk about what those car payments could have become. Remember the $500 fork? Every single month, the Parkers are sending $1,000 toward 2 depreciating cars. Let's say they made a different choice. Let's say they each bought a reliable used car for $10,000. A Honda Civic, a Toyota Corolla, something boring, something unglamorous, something that gets you from point A to point B without quietly bankrupting you. They could pay cash. Or take a tiny loan they pay off in 2 years. And then, instead of sending $1,000 a month to car payments, they redirect that money through the compounding fork. $1,000 a month invested at 10% average annual return in the S&P 500. After 10 years, that's $204,000. After 20 years, that's $764,000. After 30 years, $2,260,000. The Parkers' car payments aren't costing them $1,000 a month. They're costing them over $2 million in retirement wealth. And that is the depreciation drain in action. The slow, invisible destruction of your future wealth, disguised as a normal monthly bill. Now, you might be thinking, come on, Felix, 10% is optimistic. The market doesn't always return 10%, and you're absolutely right. Some years it returns 25%. Some years it drops 30%. But over any 30-year period in the history of the S&P 500, the average has consistently landed between 8 and 11%. Even if you use 7% to be conservative, $500 a month for 30 years still gives you over $560,000. At 7%, that's still more than $500,000 from the same monthly amount as a car payment. And here's the dark irony. According to the Federal Reserve's 2024 report, 37% of American adults cannot cover a $400 emergency expense with cash. $400. And yet the average American is paying over $700 a month for a car payment. We can't handle a $400 surprise, but we're voluntarily signing up for $700 monthly obligations that last 6 to 7 years. That math doesn't just not work. It's financially suicidal. You might also be thinking, but I need a nice car for work, or I need something reliable and safe. And I hear you. Nobody's saying drive an unsafe car. Nobody's saying walk to work in the snow. What I'm saying is that reliable and safe does not mean brand new. A 3-year-old Toyota Camry with 30,000 miles on it is every bit as reliable as the new one on the showroom floor. It just costs $15,000 less and doesn't come with a 72-month financial prison sentence. So here's what this actually means for your life, right now, today. Here's what the $500 fork feels like day to day when you're on the wrong side of it. It feels like checking your bank account before buying groceries. It feels like saying no to your kid's birthday party request because $40 might be needed if the check engine light comes on. It feels like lying awake at 2 a.m. doing mental math about whether you can afford new tires this month or if you need to push it to next month and just pray it doesn't rain. It feels like being one unexpected expense away from disaster at all times. It feels like making $85,000 a year and still feeling broke. And I need you to understand something. If any of that sounds familiar, this is not your fault. This isn't about personal failure. That's not what this is about. The system is designed this way. Car manufacturers spend billions on advertising to make you feel like you need the newest model with the biggest screen and the fanciest features. Dealerships are trained to focus you on monthly payment amounts instead of total cost. Banks make money on every year they add to your loan term. Nobody in the transaction has a single incentive to tell you that you're about to quietly drown yourself financially for the next 7 years. The system is designed to get you into the car, not to make sure you can comfortably afford everything else in your life afterward. The average American believes they need $1.46 million to retire comfortably, but the actual average retirement savings in America right now is $88,400. That's a gap of $1.37 million between what people think they need and what they actually have. And a massive chunk of that gap is sitting in your driveway right now, depreciating. So what do you actually do with this information? Here are 4 specific steps. Step 1. This weekend, pull out your bank statement and add up every single dollar that goes toward cars each month. Not just the payment, the insurance, the gas, the maintenance, the registration, the parking. Write down the real number. For most households, it's somewhere between $1,000 and $2,000 a month. You cannot fix what you refuse to measure. Step 2. The next time a car payment ends, do not immediately replace it with another car payment. This is the most powerful financial moment most people waste. When your loan is paid off, take that exact monthly payment amount and set up an automatic transfer into a low-cost S&P 500 index fund. Don't celebrate with a new car. Celebrate by starting the $500 fork in the right direction. Step 3. If you're currently shopping for a car, take the purchase price you were considering and cut it in half. Seriously? If you were looking at a $40,000 car, look at a $20,000 used car instead. Take the difference in monthly payments, roughly $300 to $500, and invest it every single month. In 10 years, that decision alone could be worth over $75,000. Step 4. Run your own numbers this week. Go to any free compound interest calculator online. Type in whatever you're currently paying in car costs each month. Set the return to 10%. Set the timeline to 30 years. And look at the number. Really look at it. Because that number is the real price of your car, not the sticker on the windshield. The retirement wealth you're quietly giving up every single month. Remember that person at the beginning of this video? The one making the same money as you, living in the same city, driving a car that costs half as much? That person isn't winning because they got lucky. They're not winning because they got a raise, or an inheritance, or some secret investment strategy. They're winning because every single month, they make the same boring, unglamorous, unsexy decision. They send $500 down the compounding fork instead of the depreciating fork. That's it. That's the entire secret. There is no secret. The person driving the flashy new car is probably lying awake at 2 a.m. doing mental math about their bank account. The person driving the older, paid-off Honda is sleeping like a baby, knowing their money is quietly working for them while they dream. That car payment might make you feel wealthy, but it is mathematically, provably, undeniably keeping you poor. So the next time you're sitting at a dealership and someone slides a piece of paper across the desk that says $500 a month, remember the $500 fork. Because that piece of paper isn't offering you a car. It's offering you a choice between a $3 million retirement and a 30-year headache. Choose the boring fork. Your future self will thank you. If this video opened your eyes to the $500 fork, hit subscribe. I break down the hidden math behind the financial decisions that are quietly shaping your entire life. And I promise you, the next video is going to make you rethink an even bigger number than your car payment.